Hi there. Welcome to The Open here on BNN Bloomberg. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Canada-U.S. Trade Minister Dominic LeBlanc is traveling to Washington today to meet with his American counterpart. This visit comes ahead of a mandatory review of the Canada-U.S.-Mexico trade agreement. U.S. Representative Jamieson Greer suggests the Trump administration is unlikely to rubber stamp a renewal. Shares in Marvell Technology are surging in pre-market trading today. This comes after NVIDIA's Jensen Huang predicted the semiconductor and networking company will be the next business to hit $1 trillion valuation. That's more than 5 times its current capitalization. NVIDIA took a $2 billion stake in Marvell 3 months ago. And shares of Dollar General are rising in pre-market trading as well as it beat analyst expectations on profit and sales in its first quarter report. The company says it was able to raise prices to offset severe winter weather and higher fuel costs. The American discount store chain also raised its profit and sales forecast for the coming year. It plans to open about 450 new stores in the U.S. and 10 in Mexico. And we're keeping an eye on U.S. futures today, all 3 trading down to start the morning. We'll continue to watch that for you. Also watching the TSX, which closed in the red as well yesterday, losing a couple points down below 35,000 points, rather, well down below that. We'll keep watching that today, too. It was mostly the materials sector that was dragging the TSX down yesterday. And, of course, we're watching the price of oil as well. It is edging down this morning after seeing its biggest gain in a month yesterday on the heels of the latest U.S.-Iran standoff. Today, down by almost a full percentage point at the moment. Both Treasury yields and the dollar are retreating from yesterday's highs after Hezbollah and Israel agreed to temporarily halt cross-border fighting. Oil is also giving up some of its gains, as we just showed you. So let's get more now from Carl Shimoda, Chief Market Strategist at Corpay. Good morning. It's great to have you join us.
Good morning, Lindsay.
What is the main reason, do you think, that we saw oil prices really surge yesterday and then falling again this morning?
Right. Iran saying yesterday that essentially that the Lebanon conflict, Israeli attacks on targets in Lebanon were a red line that was causing them to walk away from the bargaining table, as it were. That, sort of reminded markets of the supply crunch that's ongoing within global crude markets. That lifted benchmarks and also, pushed up on U.S. yields and the dollar as well. And so we're now seeing that reverse a little bit just on the assumption that, if we do see a ceasefire between Hezbollah and Israel, that might bring Tehran back to the bargaining table and, sort of set the foundation for another round of talks here.
So much volatility, though, over the last couple of months. Do you feel like markets are starting to become a little more immune, at least to the constant back and forth that we're hearing coming out of these potential peace talk deals?
Oh, no question. Yeah, it is. It's the boy who cried wolf at this point. We kind of keep running at the football and finding out that the deal is not quite what it was cracked up to be. Markets are growing more and more wary of sort of overreaction. And one interesting sort of side effect of this is that we're seeing lower volatility in a lot of asset classes because participants are just basically unwilling to place big directional bets on anything in an environment in which you can get sideswiped really, really quickly. No, unfortunately, there's sort of this mood music in the background, almost like a horror movie, in the sense that, as we see these global stockpiles in the energy complex wound down, it is getting closer to the point where we might see a nonlinear rise in oil prices and very severe knock-on effects for the global economy. So, there is a very high level of concern out there. There's just less reaction to sort of that everyday headline burst that we've become accustomed to seeing.
What about how this is affecting Canada in particular? Geopolitics, how are they weighing on Canada's exchange rate at the moment?
They're kind of keeping us fairly flat here. We're not seeing a lot of volatility in the dollar Canada pair right now, the dollar Canada exchange rate pair, and the main reason there is that we do have this boost coming from energy revenues. We are seeing higher oil prices translating into better export revenues on one side, but at the same time we're having that negative knock-on effect that higher oil prices tend to deliver to household consumption. What is sort of interesting, I guess, in the backdrop to that is the fact that interest rate differentials between the Bank of Canada and the Federal Reserve have sort of stabilized here. At one point, we were pricing 3 hikes from the Bank of Canada this year. We're now back to 1. The Fed is holding fairly stable in terms of how markets expect it to move by the end of the year. And so that is removing a big impetus for movement that we've historically seen in the loonie over time.
When it comes to the loonie, I want to get to interest rate decisions because that's happening next week in just a moment. But compared to other currencies like the yen or the euro, how does the loonie stack up at the moment?
Very flat. We're seeing a lot more movement in other currencies. They're not particularly volatile either, but dollar Canada is remarkably quiet right now. One of the things that is sort of astonishing right now is that if we look at implied volatility, and so this is sort of a technical measure, but it's derived from option markets and the expectation for how much we expect markets to move in the future. Implied volatility in the Canadian dollar right now is lower than it is across any other major currency. And it's low right across the forecast horizon, right through to, for example, a year out from now. And so markets are not only expecting that, that these sort of geopolitical shocks don't rock the Canadian dollar, that they don't move it, dramatically outside of the current trading range, but they're also expecting the USMCA negotiations to leave a very minor mark on the currency over time.
Okay, so back to the rate decisions. You kind of already gave your prediction on the Fed. What about the Bank of Canada? What do you expect to hear from Tiff Macklem next week?
I think they're going to stay in neutral, and I'm definitely not alone in thinking that right now. The reality here is that the Bank of Canada is faced with this slowing Canadian economy, weak domestic demand, coming from businesses that are not investing amid all of the uncertainty, and households that are looking at that uncertainty, but also looking at their house values and pulling back on spending. And so what that means is that there is no demand-led inflation happening in the Canadian economy. It's not like the post-pandemic period where consumers and businesses were going out, splashing out a lot of money, and that was driving up prices. That's not what's happening this time around. Instead, we're seeing energy prices, affecting overall inflation measures. And so against that backdrop, the Bank of Canada is likely to stay very, very neutral. They're not going to show their cards. They're going to say, we think policy's in a very good place to manage the uncertainties facing the economy right now. We're not willing to push it very dramatically in one direction or the other. And they're not going to provide us any guidance as to when they expect to hike in the future. I don't think they're in a place yet that they want to give us a clear hawkish bias and let markets, sort of run with that. So unfortunately for those expecting some volatility here, the Bank of Canada next week might be something of a non-event.
What about the fact that we are now in a technical recession? Do you think that sways or changes anything for the Bank of Canada, or as you were saying, maybe just not yet?
Not yet. And you're very, very on point there. It definitely does. It does tell them something about the state of the economy. The fact that, we did not see the economy essentially grow for the last 2 quarters is a reflection of that weak underlying demand. But I would also point out that a lot of the swing in GDP that showed up in the first quarter there and the last quarter of 2025 was really driven by trade issues and recalculations there, inventories, things like that, that do not tend to reflect the long-term direction of the economy. So we know that the Canadian economy is sort of moribund right now, that it's very, very weak. But that print does not necessarily represent an apocalyptic outlook for the Canadian economy. So this is an economy that needs support. That is starting to come in, but it's not an economy that requires sort of emergency level stimulus right now.
All right, we'll leave it there. Carl Shimoda, Chief Market Strategist at Corpay. Really appreciate your time. Thanks for joining us.
Thank you.
Coming up, shares of ARM Holdings extend the rally on new NVIDIA Microsoft tech powering the next wave of laptops and PCs. We will hear from the CEO of ARM right after the break. ARM shares continued to rally after NVIDIA and Microsoft unveiled a new platform built on ARM technology. Earlier, Bloomberg spoke with Rene Haas, CEO of ARM Holdings, who says strong AI demand could help it reach its $15 billion U.S. sales goal sooner than expected. Here's more of that conversation.
These classic cases of right product, right time. Two interesting technologies are being put into one. There are 20 ARM CPU cores inside that chip. That's the most CPU cores you can find in any laptop SoC, designed in partnership with MediaTek. And then NVIDIA taking their Blackwell RTX GPU, combining it with that into a super chip, and you have the most performant GPU on the market that can run agentic AI. So as we're moving more and more towards these heavy-duty workloads on PCs running agents, this is the perfect chip at the perfect time. So we're super excited about it.
You know, all the guys that are clamoring around the Computex halls, they're all asking, what about battery life? Because the RTX past iterations, if it's running the games, and that's something Jensen Huang, showed, advanced capabilities, agentic AI, and high processing graphics, battery life is a concern. What alleviates your concern that battery life, all-day battery, is a tough thing to fulfill?
This is the hallmark of all things ARM, right? Because we are literally in every single smartphone on the planet, so everything we do is around power efficiency. So we extend that into the laptop space. The previous laptops have been announced on ARM, whether the Mac Neo or the MacBook Air or the Google Chromebook or even some of the Windows machines, they've got the best battery life in the business, 18 hours, 21 hours. So we're expecting the products built with this chip to be terrific.
They can deliver then?
Yeah, absolutely.
Okay. Qualcomm Snapdragon competes on the Windows on ARM space as well. What percentage of the PC market do you see ARM really having its fingerprints all over by the end of this year, next 5 years, let's say?
Yeah, I think when you look at all the categories, because ARM is the only supplier on the planet from a CPU architecture standpoint that does all the platforms. What do I mean by that? Mac OS, Windows, Chrome, and Linux. When we look at that all in totality, could we see a 50% number at the end of the decade? Absolutely.
Oh, wow. Okay. But at the same time, you're also moving into, I guess you could say, a strategy shift, a radical move, that you're going to start doing server chips of your own, branded with your own name, maybe. But again, did you see a gap? Let me just ask you that. What gap did you see in the market that you would not necessarily go against your competitors, but you're going to be putting a product up there against some of your key competitors like NVIDIA? Yeah,
so if you look at the evolution of our technology over the last 4 or 5 years since I became the CEO, one of the things we've seen is a consistent demand of please do more. And we started taking our IP, putting them into blocks that we called subsystems, combining everything to help people build chips faster. We did that about 2-3 years ago. The demand on that has been fantastic, and that naturally started to lead into customers asking us, hey, could you take these subsystems and just finish it off and build the chip? Because in some cases, the final chip, greater than 90% of the IP on that chip belonged to ARM, belonged to those subsystems. So first off, we were asked to do it. Meta asked if we would, and we said yes.
I was going to ask you about Meta. That's pretty much the launch customer.
That was the launch partner. And secondly, it was a market that was really underserved. There are folks like NVIDIA, Amazon, Google, Microsoft who can build ARM server chips. But there are some folks who just don't have that capability. The Cloudflares, SAP, some of the customers of this AGI CPU, and also Meta. So really, we were responding to customer demand.
How do you see this business growing over the next year and next 5 years? As you add, perhaps I would assume, you're already in discussion with other launch customers.
Yeah, so we talked about with analysts back in March about a $15 billion type revenue by the end of the decade. We're well on track to hit that. I'm hoping we can even hit hit that sooner. Demand has been stronger than we anticipated. And I will say that's a combination of just all things AI, but also, frankly, it's a great product. It's 2 times the performance of an x86 at the same power. So demand has been fantastic. So the number we've talked about publicly is 15 by the end of the decade, 15 billion. I'm very confident in achieving that target.
Well, you said that 90% of ARM architecture built into that. Were you literally simply looking at the market and saying, we can be at the top of the pyramid? I mean, NVIDIA has taken that space.
What we were seeing was, huge demand for power-efficient technology. And when you think about what goes into building out AI data centers, power is one of the hugest pieces of everything. So if you can build a very efficient machine, it helps save money, it helps save power. Then with all things agentic AI, a lot of that work is done by CPUs. Yes, the GPU does a lot of work to generate the token, but the distribution of that token, the administration of that token, the orchestration of that token, that's only work CPUs can do, which is why people have been talking about, oh my gosh, the CPU demand, it's just going off the charts. It's largely because of that.
How much of this is also driven by the fact that SoftBank now pretty much owns ARM Holdings? You, I believe, are the CEO of SoftBank Group International.
That's right.
They have a portfolio of AI companies. Do they look at this space and say, we need to be there?
There's a very close symbiotic relationship between the SoftBank Group and ARM. SoftBank owns 85% of the company-ish, somewhere in that range. But when you think about things that SoftBank has been very focused on, whether it's around energy, whether it's around infrastructure, whether it's around financing, SoftBank and Masa just announced a 5-gigawatt project in France earlier this week. Having connections between what the two companies are doing is really important. So I took on this role inside SoftBank Group International to really help with the coordination. But to be clear, my day job is to CEO of ARM.
That's right.
My number one primary duty is to shareholders of ARM.
Up next, we are 1 month away from the primary Kuzma review deadline, and we got an update on the status of discussions among the 3 North American parties, and we'll have more on that after the break. July 1st is fast approaching, and yet Canada remains out of talks between the U.S. and Mexico. We got interpretation from John Weeks, member of the expert group on Canada-U.S. relations and former NAFTA chief negotiator.
They've said that these are basically technical discussions, but in the end, a trade negotiation is made up of a whole series of technical discussions plus some high-level diplomacy, and I think you need to be there for all the parts of it. So I think we should be trying to make sure that that Canadian negotiators are in the room for what's going on now.
Because what happened there will likely mean some pressure on Canadian negotiators, perhaps to give up more than they want to.
Well, I think the first problem is that they've said that the Mexicans and the Americans, they issued a press release saying they're having technical discussions including on major industrial sectors. And I understand that they're actually talking about how they might improve the rules of origin, improve in quotes, in the automobile sector. So that's definitely something of major interest to Canada.
Yeah.
And if they start developing some ideas about how to put these different, for changing the rules, then we may have an uphill battle to try and change it to make sure our interests are taken account of.
Yeah. So basically, just to loop the viewers in a little bit more, they're looking at how much of an automobile, for example, would come from American, both American resources and, I guess, American workers. And that could significantly affect Canada's contribution. Is the auto industry, you think, the biggest focus of these discussions?
Well, I think that is one of the biggest places where Canada stands to be put at some risk. But I think, potentially it's going to cover a number of other sectors too. We still have major tariffs in place on aluminum and steel products, for instance. So that's a big problem as well.
You talk about the Fortress North America approach. Can you explain a little bit about how that works and why that could also be a problem for Ottawa?
Well, I think what the Americans would like us to do is, particularly in a number of major industrial sectors, is agree to erect trade barriers against countries outside North America, and in exchange for having lower tariff barriers inside North America. They haven't been clear about whether we'd still get back to the real free trade conditions we had with the United States earlier. And I think the problem here is if we start erecting trade barriers against other countries like the European Union or our partners in the Trans-Pacific Partnership, we may well, that'll violate our obligations under that agreement, and we'll have repercussions for the kind of trade relationship we have with them. So this is really possibly we get into a Fortress North America situation, and we make it much more difficult for Canada to diversify its trade relations with other countries.
Can you be a little specific about what sectors that would pose a problem for? I know we're sending more energy, and we now are getting more energy contracts with other countries, as you mentioned, European Union, China, maybe India. So I'm wondering if there are certain sectors that it would be hurt more by that Fortress North America idea.
Well, I think the government should be honest with Canadians about where it would be prepared to contemplate a Fortress North America approach, because potentially this could be a big problem in a number of areas. And basically, any area where you start creating a Fortress North America, it's going to create problems for us in our relations with other countries. I think to some extent, China's perhaps been the biggest focus in thinking about adopting this approach, but there's certainly been no assurance that it would be limited to China.
Wondering if Canada can delay the negotiations. Midterms are in November, of course. There could be a change in the power balance in Washington. But the second part of that question, of course, is can our economy withstand a delay?
Well, obviously we're under a lot of pressure. Some sectors are in real difficulty right now, and I think we need to do what we can do to try to alleviate that pressure or eliminate it. But it's not clear that we can do that very easily, and maybe not at all. And I think that the question is, do we want to enter a new deal with the United States now that would be less favorable than CUSMA, the current agreement that we have, and that we would agree to having duties applied to us? Or is it better to be constructive in the talks, but not be in a big hurry to conclude them? Because I think there's some prospect that Trump's trade policy is really under pressure in the United States. And I think, with the run up to the midterms elections and what can possibly come out of those elections, it's quite likely we'll see some shifts in American trade policy in terms of what they would actually like to see happen. And that could create more conditions in which we would have a better shot at getting a reasonable deal.
That was John Weeks, member of the expert group on Canada-U.S. relations and former NAFTA chief negotiator. The opening bells are coming up next. Stay with us. Here are the opening bells at the NASDAQ. Xenon Pharmaceuticals is ringing the opening bell. On the New York Stock Exchange, we've got Dime ringing the opening bell this morning. And on the TSX, Long Point Asset Management is opening the markets. It's time now for the first 15. You're watching BNN Bloomberg. Trading is just getting underway, so we're going to check in on the equity markets to start your morning. The TSX seeing some slight gains to start the day, in the green already, up by 0.2% after losing some ground yesterday. We've got the S&P 500 and the NASDAQ both down by about 0.2% at the moment. This comes after these two both saw a record run last week and some highs yesterday as well. So we'll keep watching those. We're honing in on some Canadian stocks on the TSX, as always. Barrick Mining is the first one we'll tell you about this morning. There's a report that says the company is considering a London listing for its African business, with the potential all-share transaction with Endeavour Mining seen as one of those options. So you can see Barrick Mining up by 0.5% to start the morning. Mining stocks also being lifted by higher metal prices today, so we're seeing that reflected in Barrick Mining. We're also watching Allied Gold. Allied Gold was raised to a buy at Canaccord after the company received approval under Canada's Investment Act for the proposed acquisition of a Chinese mining company. And we're continuing to watch that today. Allied Gold up by almost 2% to start the morning. And we're also watching Parex Resources. This company has jumped the most in 14 months after closing its acquisition of Frontera E&P. And Parex Resources finished near the top of the TSX yesterday. We'll see if it can keep that momentum running today, up by 0.5% to start the day. And for movers south of the border, we are now joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Jeff, good morning. It's great to see you. We'll start with HPE. This stock's surging after some intense demand for AI. Tell us more.
Yeah, this is the latest kind of old school tech stock to come roaring back to life here. HPE is up 30%, almost 30% in the pre-market session to start the morning today. They reported results last night, which were well ahead of where Wall Street expected them to be. Hewlett-Packard Enterprises, what's driving this company is demand by AI companies and by kind of the AI data center build-out for its networking and server equipment. The company now sees its revenues growing at 31% this year. Previously, expectation was about 19%. So as you can see, that is well ahead of where Wall Street expected it to be, well ahead of where the company previously expected it to be, and that is driving gains further. The other kind of additional wrinkle here with HPE this morning is they've had an activist investor kind of in there, as you can see from the stock chart, with flat for so long. They had an activist investor come in Elliott Investment Management previously, and they have now announced that one of the partners at Elliott Investment Management is now going to be on the board of directors. So a few moving parts this morning, but the big one, the big headline takeaway here is that the AI demand story is continuing, and it is driving some life in some of these old, various people have called them dinosaur tech companies that are coming back now. And 30% gains so far. Really, really sharp gains here.
Yeah, interesting to see how some of those companies are going to rally throughout this kind of AI build out. Okay, you're also watching Intuit. It dropped almost 5% in pre-market trading this morning as Goldman downgrades today. What's the reason for the downgrade?
The reason for the downgrades is that Goldman is just seeing additional competition coming specifically in the company's tax business. Intuit, they have the TurboTax business. They are one of these companies that has been kind of caught up in this SaaS apocalypse, as it's been called on Wall Street. That's software as a service with the word apocalypse attached to the back of it. So the stock has been under a lot of pressure, but it's worth noting that Goldman is kind of making a call on its own here. It now has the only sell rating of 32 analyst ratings on this stock, and the new price target of $276. That would imply a 22% drop in this stock going forward. So it is quite a negative rating, but it's also worth noting, this is the worst or one of the worst performing stocks in the S&P 500 in the pre-market session. It's worth watching over the course of the trading day to see whether Goldman's view on whether or not Intuit continues to come to fruition. It's also worth noting, we spoke about Intuit a few weeks ago when they reported results, and the results were not overly good at the time. And analysts at that time said, we just come through tax season and the results were disappointing. So what does that leave for the rest of the year? Anyway, worth watching this stock over the course of the trading day today.
For sure. And I think you said this, but this is the only negative rating among 32 analysts. So interesting to watch that. Okay, Bloomberg's Jeff Morgan reporting live for us. Jeff, thanks so much. Great to see you. Coming up, shares of Hewlett-Packard are surging today, and we'll tell you why right after this. Stay with us. Shares of Hewlett-Packard are surging after reporting Blockbuster's second quarter. Revenue was up 40% from a year ago, and the server maker bumped its full-year EPS guidance by a full $1. Let's get reaction now from Michelle Connell, president and owner of Porsche Capital Management. It's great to have you join us. Good morning.
Good morning, Lindsay. Thanks for having me.
Were you surprised by these results that we saw from Hewlett-Packard's?
I was, but I shouldn't have been, because I'm an owner of Dell, and Dell, blew the doors off of their earnings last week. So really shouldn't be surprised, because Hewlett-Packard is number 2 in terms of servers. So it makes sense, right, that if they can sell AI servers, that they're going to benefit as well.
Right, because I was going to ask you, like, where does Hewlett Packard fit into the AI build out? But I guess it's in terms of manufacturing servers.
Yes, it does, and they do other servers, and they also have a retail or a PC side, just like Dell does. But the difference is that I don't see the partnerships for Hewlett Packard that some of the other AI server players have, like Dell. But what I thought was really interesting was that their CEO said that Hewlett Packard's pipeline or the orders behind the pipeline is multiples, many multiples of their backlog of $7 billion. And their AI server sales for this quarter were triple digit growth rate over the previous year. So they're benefiting as well.
It's interesting, though, with all of that in mind, like you mentioned, you don't see the partnerships that other companies are kind of forming at this time. Why is that? Or is it just a matter of time before we see partnerships for this company, too?
Everybody is realizing that they have to have some sort of partnership, whether it's a software company or a SaaS company. Those have been hurt, so they're reaching out and having partnerships with NVIDIA, et cetera. And also because the build out takes so much money, and we're looking at another $2 trillion this year, and then potentially another $8 trillion rather between now and 2030. That's a lot of money. So these partnerships are necessary if you're going to need a lot of capital to deploy.
Mm-hmm. How has the AI build-out been affecting your investment strategy?
Well, I'm biased, Lindsay, because I started out as a semiconductor analyst in 1998, like back in the day. So I've cut my teeth on these names. And so I've held a fair number rather, not a multiple, but a lot of semiconductor stocks. I was fortunate enough, I'd rather be foolish than smart is kind of the saying sometimes. I own Dell, and I bought that in December and I did well. And I've also been weighing in on some of these SaaS or software names because they've been so beaten up, and we're starting to see that, yes, we are going to need software as well as hardware for an AI build out. So you're seeing some of those names play out and get some attention too.
There is obviously some other companies that are reporting this week. And today, Palo Alto is one of those that you've got your eye on. What are you watching for there?
I hope that they also have great numbers for their sake, because the stock is up 52% year to date. It's now at a forward PE of almost 80, meaning that you're paying 80 times next year's earnings. And they also recently acquired CyberArk. So they have a lot to be able to show their shareholders, because there's been such an interest in them and you've had this rally up. So they better show that they're worth it.
Alta is another one that is reporting a little later today. It's down 16% year to date. What are you going to be watching for there?
I want to see if their traffic has picked up. They've been losing their competitive edge. And I also think customers or consumers, even if it's something like discount cosmetics, they are cutting back. But good news for Ulta, the discounters are where you're going to go first as a client if you need those type of things. So they need to get more customer share, and they've also need to get their costs under control. And I think part of that is how much we're having to pay more, not only as consumers, but as companies rather, for transportation. It's more expensive to ship your goods, and Ulta is affected by that too.
You're also watching, we know tomorrow, Broadcom is reporting earnings. This company getting a boost today in the pre-market because of some things that the NVIDIA CEO said, as well as plans from Alphabet. But what are you watching for Broadcom tomorrow?
Full disclosure, I own it in my portfolios, and I've owned it for a while. I like this stock, even though it's up 30% year to date, but it's still cheap on a forward price to earnings basis, less than 40 times. But what's interesting about Broadcom is that their focus has been on need something specific to your company, this is where you're going to go, versus NVIDIA is more of a GPU or a generalized semiconductor. So I think customization is what is really helping Broadcom. So I expect them to do well and take up guidance too.
Other than technology, where else are you finding areas of opportunity right now within the market?
On the other side, I like utilities because utilities are benefiting from the data center build out. And there's some out there that are still pretty inexpensive. And they also usually pay a dividend. And that's a nice way to balance out the hyper growth of your technology names in your portfolio. And commodities will continue to have some interest for me too, because inflation doesn't seem like it's going to go away anytime soon.
Okay, we will leave it there for now. Michelle Connell, president and owner of Portia Capital Management. Always good to have you on. Thanks so much.
Thank you, Lindsay.
Yesterday on Market Call, we were joined by Teal Lind. He is a manager of the Lind Equity Fund, and he was covering North American large and mid-cap stocks. These were his top picks: HubSpot, Colliers, and Blue Owl. Today on the show, we've got Joe Hegner. He's the CIO and founder of Astrozoa Capital, and he'll be taking your questions on North American equities. Just ahead, Canada-U.S. Trade Minister Dominic LeBlanc is traveling to Washington today to meet with his American counterpart. We'll see what's on the table for this meeting right after the break. Dominic LeBlanc prepares for high-stakes talks in Washington with the U.S. trade representative as pressure mounts on Canada to reassert its presence in North American trade negotiations. Let's get more on this story with CTV's Annie Bergeron-Oliver, who joins us live. Annie, good morning. So what can you tell us at this point about what we know about this meeting?
Well, this is the first in-person meeting in Washington between Dominic LeBlanc and Jamieson Greer since March. So that in itself is a sign of progress that these two are getting back to the table. Talks have essentially been stalled between Canada and the U.S., so the fact that this meeting is happening is a good sign. Now, Mexico is, by what a lot of experts say, further ahead than Canada. They have just wrapped up their first round of negotiation in formal talks, whereas Canada has not launched formal talks and does not have a date for formal talks to begin. Now, the Prime Minister just had a scrum. He talked to reporters saying that Mexico and the United States had about 60 issues that they had to get through in their review. And he said that's why the Americans wanted to talk to Mexico first. But now that they have had some progress there, now the time is to focus on Canada. The Prime Minister says there are about 30 issues between the United States and Canada that have to be dealt with. One of the big issues he pointed out was these tariffs on steel, aluminum, and automobiles. The Canadian government wants to see these tariffs removed altogether, saying that they are unfair to Canadian businesses and producers. The Americans have signaled that they don't intend to drop these tariffs altogether, and that other countries have signed on to trade deals despite still having tariffs in place. So this is really one of the big issues that has to be dealt with. The Canadian government has said it's essential to have these discussions around tariffs. Now, the other thing that's happened today is Dominic LeBlanc sent a letter to his American counterparts saying that Canada wants to see CUSMA reviewed for 16 years. This is one of the options as of July 1st. You can either allow yearly negotiations for up to 10 years to get a new deal, or you can do a 16-year renewal. The Canadian government now saying today, sort of for that first time to the Americans, they want to see this CUSMA deal renewed for 16 years. However, Dominic LeBlanc has said that he is open to discussing and looking at other proposals from the Americans or from the Mexicans, as long as it is mutually beneficial for all three. So again, this is a very quick meeting today. Dominic LeBlanc is only in Washington for the day, and we're not expecting to have formal talks started after this meeting, but it's a chance for the two sides to discuss proposals that are in place and some of these 30 structural issues, if you want to call them that the Prime Minister highlighted.
And obviously, this free trade deal impacts more than $1 trillion of the Canadian economy each year. So it's a lot of money. This is a big deal. I'm not sure if you know specifics yet in terms of some of the sticking points, but obviously we've heard a lot about, auto sales, Canadian dairy, liquor sales have been a real irritant for the Trump administration as of late. Have you heard any specifics in terms of what might be top of the agenda?
Well, you just highlighted some of the big ones. Let's start first with these 30 issues the Prime Minister pointed out. Tariffs, again, a really big issue here. He does not want to see tariffs on steel, aluminum, or the auto sector. Another one we've heard with the negotiations with Mexico, that content of origin is a big topic right now. Under previous negotiations and free trade agreements, it was more looking at North American content of origin. Now the Americans, at least in their discussion with Mexico, are turning that into U.S. content of origin. They want 50% of anything in the automobile trade to be a U.S. origin. So that's something that also needs to get discussed here, according to the Canadians, is it going to be North American content of origin or U.S. content of origin? And if it's U.S., well, what exactly is this percentage, and how can it still be fair to Canadian and Mexican automakers and auto parts manufacturers? So that's another big one.
Right.
You also point out, some of these are provincial. The Americans are very unhappy that many liquor boards in Canada are still not serving and still not allowing American liquor to be on their shelves. The Prime Minister said that today as well, that some of these 30 issues that the Americans have with Canada are provincial in nature. And so this is likely one of those big issues. Then you also have to look at supply management. This is something that Donald Trump has highlighted repeatedly. He thinks that the quotas are unfair, that they are hurting American producers, and he would like to see changes to supply management. That's an issue that the Prime Minister has said is not on the table. So that is likely to be another big topic of discussion that comes up, and a sticking point here on a new negotiation for CUSMA.
Okay, CTV News, Annie Bergeron-Oliver reporting live for us. Annie, thanks so much. Coming
Thank
up,
you.
how one global robotics leader is teaming up to shape the future of AI. We'll get more after the break. Robotics, a leader in automation and industrial robots, is working with NVIDIA to explore the next wave of physical AI. Earlier, Bloomberg spoke with Craig McDonald, business line managing director, industries at AB Robotics, for his take on the physical AI technologies.
ABB started in robotics in 1974. I think we were the first to introduce microprocessor controls into the robotic space. And over the next 50 years, we've come up with a very wide range of industrial, collaborative, and mobile robots. And we spent probably the last 20 years evolving that system now into robots that can operate more autonomously and in a more versatile manner. So think of robots with intelligent eyes. Think of robots with hands and ability to manipulate. And also think of robots that now have a brain. But these are evolving to a point where ultimately, simulation becomes more and more important because you're merging so many different technologies. The ability to create hyper-realistic synthetic data to recreate these environments is truly bringing these technologies together and is really the next step that we're working on.
So how are you then as well partnering with NVIDIA? Because NVIDIA stole all the headlines yesterday, no doubt, with their new laptop to take on the likes of Intel and AMD. But of course, we all know that they have the architecture to go into those big data centers. And they have the new infrastructure with Vera Rubin in full production right now. Absolutely. But you also use NVIDIA in a way to sort of virtually game out a scenario for a client virtually, so they don't have to necessarily have a physical prototype. Tell us about that.
Yeah, so if you look up until now, synthetic data generation hasn't been accurate enough for robotics. Many of these applications are 50 to 60% accurate. And when it comes to systems that need to operate safely, at speed, and at scale in an industrial hardened environment, it hasn't been achievable. Over the last year and a bit, and we announced in March our collaboration with NVIDIA, we've really merged their capabilities in accelerated compute and their abilities with wide world simulation with our industrial knowledge, our digital twin capability, and of course our robotics, to address the sim to real gap.
Yeah.
And in a number of applications, most notably in the electronic space, we managed to shrink that sim to real gap to a very, very close correlation. So we can, with a 99% accuracy now, recreate robot motion in the virtual space when compared to the real space.
So what kind of cost savings are we talking about? And also, more importantly, perhaps, is time to market.
Oh, absolutely. You can now reimagine how you bring product to market. So think if you're sitting in Taiwan right now, you're designing a product here, you're having to apply it in China, apply it in India, apply it in Vietnam. You need to be able to, in a concurrent way, generate those production systems, but also train them for all these manufacturing edge cases, so that you can then concurrently engineer, taking probably about 50% out of your time to market, but also at the same time take about 40% of your total cost out, because from day one, you've pre-trained for all those manufacturing edge cases, so you can hit productivity much more earlier than traditional systems.
So through this, or just the big uptick, obviously, in physical AI, how are new installations for you guys looking this year?
I mean, it's the electronic space specifically is going through a super cycle. I think there's been a lot of activity on the consumer electronics side, but also more recently, the AI compute side has got to volume levels that have justified robotization. Many of these systems up until now were only partially automated because of the lower volumes compared to the consumer electronics. But I think you've all seen the headlines on data centers and how that market is growing exponentially. And with that comes the robotization of that space.
Coming up, Canadian drug maker Apotex is looking to raise as much as $1.1 billion in an IPO, marking the largest public market debut for Canada since 2021. More on that after the break. Hi there. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following in the BNN Bloomberg newsroom. Canada-U.S. Trade Minister Dominic LeBlanc says the trade agreement with the U.S. and Mexico should be renewed for 16 years. He made that point in a letter to his counterparts. LeBlanc is in Washington today to meet with U.S. Representative Jamieson Greer. Canada's official negotiations over its trade agreement with the U.S. have yet to begin. Shares in Hewlett-Packard Enterprise are rising today after its forecast for annual sales topped estimates. HPE cites growth in AI driven by demand for its servers and networking. The company is one of the largest makers of computing equipment, benefiting from the demand from hardware to train and use AI. And shares in Alphabet are down in trading today. The parent company of Google plans to sell $80 billion in stock, including a $10 billion investment by Berkshire Hathaway. Alphabet says the capital will fund investment in AI. Alphabet stock has more than doubled in the past year as investors applaud its AI investments. And we're keeping a close eye on the TSX today. It is in the green, up ever so slightly at this point by 0.3%. We'll continue to watch that for you. Also watching U.S. markets today. Investors a little weary about what's happening in the Middle East. The S&P 500, the Dow Jones, and the NASDAQ now. Well, the NASDAQ's flipping between green and red, but really relatively flat to start the morning. We'll keep an eye on that as well. Canadian drug maker Apotex is looking to raise as much as $1.1 billion in an IPO, marking the largest public market debut for Canada since 2021. Our next guest says a successful listing could help attract both domestic and international capital to Canada. So let's get more now from Jay Bala, CEO and Senior Portfolio Manager at AIP Asset Management. It's great to have you join us. Good morning.
Hey, good morning. Thanks for having me on.
Why is Apotex choosing now to go public, do you think?
Yeah, no, I mean, I think it's a lot of it just being driven by sort of the U.S. market. So you've seen these blockbuster, monster-sized IPOs popping up in the U.S. You know, SpaceX is supposed to go public in the next few weeks. You know, both Anthropic and OpenAI are supposed to probably go public around Q4. I think Anthropic's news came out yesterday that, you know, they had confidentially filed their S1. And so, you know, I think that the timing is right. From a Canadian context, I mean, look, I mean, it's great to see that Canada is also participating, that, you know, our sort of IPO drought that we've had for many, many years now might be finally coming to an end. And, I see the Apotex IPO as a positive sign that, there's sort of green shoots popping up again.
You have said a successful listing could help attract both domestic and international capital. What would a successful listing look like to you?
Yeah, I think there's got to be significant uptake in the capital raise, and obviously, the stock performing well over the next few quarters after it goes public. I think it's going to be one of the driving forces. Ultimately, everything comes back down to, will it have good, sort of revenue and earnings growth, and will it have an ability to join an index in the future?
And then on the flip side of that, what are the risks if the Apotex IPO falls kind of short of expectations?
Yeah, obviously, if they go out and do the road show and they're not able to raise the capital, I think, it's sort of a telltale sign that maybe, the Canadian economy and the regulatory system maybe have to adapt a little bit to actually, make it a more competitive environment compared to the U.S., right?
And obviously, we've got a lot of big IPOs coming up in the U.S., talking about that quite a bit. Anthropic just filed for an IPO. Would there be any significance here if Anthropic beating OpenAI to an IPO?
No, I don't know if there's a particular issue there. Look, at the end of the day, if you look at the three biggest companies in AI right now as pure plays, you've got SpaceX with Grok and XAI going public soon, and then you've got Anthropic and OpenAI going public. So, that's your big three behemoths. Those are the three that are going to be in that $1 trillion range. And so, look, I don't know it matters that, one comes in a few weeks before the other. But I think, what is a clear sign is, that it's a very healthy IPO market in the U.S. And look, it's going to be, we're effectively living through history at this point, right? These is going to be some of the biggest IPOs ever.
And you say the real story, or the biggest story they're going to be watching for, is what happens after these big companies go public, right? Like, what exactly will you be watching for there?
Yeah, so I think the key to all of this, I think if people are looking at just all these companies on a valuation basis only, I think they're missing part of the run here. So, what you have to look at is over the past few decades, we've done a very good job of transforming these stock markets from actively managed to passively managed through ETFs. And these ETFs have become so big that they now basically influence the valuation of these companies. So, for something like a SpaceX, which will go public in the next few weeks, the NASDAQ has already come out to say that they will be fast-tracking its admittance to the index. And so, it's going to be a 15-day window instead of 12 months. And so, the index arbitrage as a strategy is becoming more and more relevant in this case because, if you look at the grander context of this, there's $5 trillion in ETFs that track the NASDAQ 100. So irrespective of what company goes in there, they have to buy those 100. And so, SpaceX, even if they were to get a 1% allocation to the NASDAQ 100, would have, $5 billion in forced buying power 15 days out. As soon as it gets added to the index, $5 billion worth of money has to basically sell the company that got kicked off the NASDAQ 100 and is forced to buy the company that's just got added on, right?
So with that in mind, that kind of, I guess, maybe hurdle for investors and also the inclusion rules changing for some of the big U.S. indices, do you think investors should take a more kind of passive approach or change their investment strategy?
Yeah, no, I think you're going to see the convergence of, you need to be in the privates as much as you need to be in the publics. Like, you need to understand a space where everything belongs in your portfolio. So, owning an ETF as a passive instrument has a placeholder in your portfolio. But, if you don't want to miss out on the value creation, you need to have an allocation to the private markets, right? You need to own some of these stocks before they go public. If you look at these companies, like if you're looking at SpaceX, I think they're talking about a $1.7 to a $2 trillion valuation. Now, all of that value was created while it was private. And so somebody coming in has missed out on that massive, massive run, right? And so all they're getting is the secondary effects of the index arb.
You mentioned owning these companies before they go public. Wealthsimple has launched a new feature to give a retail investor like pre-IPO access. How significant is that change?
Yeah, no, look, I think that's been a growing trend for many years. I think it's, we're seeing the convergence of both private and public markets. And look, and I think it's a good thing, right? I think it's a good thing that, retail investors can now participate in some of these IPOs. A lot of high net worth investors and a lot of institutions have invested in these pre-IPO stocks for a very long time. And I think, I think a lot of retail investors are saying, how come the institutions and the high net worth people, get all this stuff, and how come I don't? So I think there's been a real push, and I think, there's a number of companies that's offering it now, right?
What do you think that changes, though, that shift for retail investors away from institutional investors instead?
Yeah, no, I think it gives them the opportunity to participate in some way. Obviously, you still have to be an accredited investor, or you have to be an institution to invest early on. And if you want to invest in some of these growth companies, many years before they go public, you still have to meet that criteria. I think, this is the beginnings of the door opening for, just regular retail investors to, buy at least at the IPO round before it starts trading, right?
Interesting stuff. Okay, we'll leave it there. Jay Bala, CEO and Senior Portfolio Manager at AIP Asset Management. Thanks so much for joining us.
No problem. Thank you.
Coming up, why Bitcoin is facing downward pressure. More on that after this. Stay with us. Bitcoin is coming under renewed downward pressure, slipping below 70,000 for the first time in 2 months. Let's take a closer look at what's driving the move and whether leveraged investors are positioning for a rebound. Joining me now is Michael Rabkin, Global Head of Business Development at DV Chains. Great to have you join us. Thanks so much.
Thank you for having me on, Lindsay.
So go ahead. What's driving that slide that we're seeing?
Yeah, so everybody wants to know what's driving the slide down. So obviously, Bitcoin's down year over year around 34%. Ethereum's down year over year close to 22%. And I have a couple of reasons for the recent sell-off here. So firstly, MicroStrategy did its first sale. So they're the largest institutional holder of Bitcoin. They disclosed in an SEC filing that they sold 32 Bitcoin to fund dividend payouts. So this broke really a long-standing never sell policy and kind of spooked the market. Second reason is capital rotation to tech. So while Bitcoin has struggled, traditionally U.S. stock markets reach record highs. And so investors have rotated capital into AI and chip stocks, really siphoning attention and investment away from digital assets. And then ETF flows and geopolitical tensions. So sustained institutional withdrawals from some of the biggest digital asset ETFs combined with the kind of a risk-off market environment, which is driven by renewed geopolitical tensions in the Middle East, really increased selling pressure. And then one of the last reasons I have here is long liquidations and fear, right? So the broader crypto market sentiment quickly soured with the crypto fear index really dropping into fear, leading into a wave of forced liquidations. And then, saying all that, Bitcoin continues to trade well below its 2025 highs, but the broader story still remains being institutional adoption. And what we're seeing is really a much more mature market than previous cycles.
You mentioned Bitcoin ETF flows as well, and I wanted to dig into that a little deeper. What story do you think that's telling us right now in terms of what you're seeing?
I think that there's fear in the market. And as I mentioned, we are in a risk-off market, especially in speculative assets, which Bitcoin is still viewed as that, right? Generally. So to say that the buyer base significantly has changed over the last couple of years, versus 3 years ago. We've seen a lot of ETFs come to the market, asset managers, family offices, pubcos, corporate treasuries, and really unlike prior cycles, which were really, in my opinion, heavily retail driven, institutional participation does continue to increase. But again, it's a short-term fear, but the long play is still intact. And the key question is really not if Bitcoin survives. The key question is how large of an allocation Bitcoin ultimately becomes with institutional portfolios as time progresses. So really the debate has shifted from whether institutions should own Bitcoin to how much Bitcoin they should own. And really the biggest difference today versus previous cycles is that institutional adoption and regulatory clarity are moving in the same direction, but just creating a much stronger foundation for the asset class. And really, to answer your question directly, Lindsay, Bitcoin is still a risk asset. It trades within the broader macro environment, higher rates, uncertainty around growth, and broader risk-off sentiment. can impact Bitcoin in the short term, even though while the long-term adoption story remains intact.
Is Bitcoin the only cryptocurrency, though, that's facing these headwinds right now?
No, Bitcoin is typically the leader. So if Bitcoin's down, you'll see the rest of the market down. Ethereum, which is the second largest cryptocurrency by market cap, it's faced downwinds as well, and so is the rest of the market. But Bitcoin continues to lead the market. The bigger story here is that confidence is returning across the broader digital asset ecosystem outside of the last 7 days, as institutional adoption grows, and really as we get more regulatory clarity, specifically the Clarity Act.
I wanted to ask you about the Clarity Act. That will move Bitcoin to the Commodity Futures Trading Commission. Tell us more about the Clarity Act and what that means, what that will do for Bitcoin.
Yeah, for sure. So this may be the most important development of the year. So for years, the industry wasn't really asking for less regulation. It was asking for a clear regulation. And so markets reward certainty. And so the more clarity institutions receive around custody, trading, settlement, token classifications, the easier it really becomes for traditional firms to participate. And so, generally markets don't fear regulation, markets fear uncertainty. And so one of the biggest regulatory stories, as I mentioned, is the Clarity Act. And the Clarity Act is essentially about defining the rules of the road for digital assets. And so for years, we've wanted that as an industry. And really the bill aims to establish clear oversight between the SEC and CFTC and reduce regulatory uncertainty. That's more important because capital tends to move towards markets where the rules are clearly defined. And for years, this has been one of the biggest questions facing our industry.
What's your outlook for digital assets for the remainder of 2026?
So there's a couple of key takeaways that I have. One being we're hoping that, the Clarity Act advances. We're still waiting for the Senate committee to vote on it. It looks like it will pass, but you never know. I think stablecoin adoption continues to grow. I think that's probably the biggest story of the year. Traditional financial institutions continue expanding stablecoin initiatives as regulatory frameworks improve. And so, like a lot of institutions recently expanded access to stablecoin offering to millions of customers. And stablecoins are really used in many different ways: cross-border payments, faster settlement, etc. And I think what we're seeing right now is digital assets being integrated into the traditional financial system. So we're seeing crypto rails such as perpetual swaps, which have been a standard instrument on offshore crypto exchanges for years. Venues like Hyperliquid have opened up the market to 24/7 decentralized access to commodities, energies, equities, and even some pre-IPO perps like SpaceX, for example. And so we've seen that token do quite well despite Bitcoin's volatility. And even at DV Chain, despite being primarily a crypto desk, we are seeing these on-chain commodities, energies, equities, like I mentioned, start to take a serious share of the volume.
Okay, we're going to have to leave it there. Michael Rabkin, Global Head of Business Development at DV Chain. Thanks so much for your time. Appreciate you joining us.
Thank you for having me on.
Up next on the ETF report, the rise of thematic ETFs, the broadening of the AI boom, and the fastest growing ETF in Canada. More on that coming up with Valerie Grimba. Stay with us. It's time now for the ETF report. The ETF market continues to evolve rapidly, with thematic ETFs replacing sectors and the AI boom lifting related sectors. So which are the best plays to invest in right now? We're going to unpack that for you with Valerie Grimba, Director of Global ETF Strategy at RBC Capital Markets. It's great to have you in studio. Good morning.
Good morning. Thanks for having me, Lindsay.
So let's talk about investors moving out of broad sectors into narrower themes. What are you seeing there? What themes in particular?
Yeah, we're talking to a mix of investors, advisors, and institutions, and they're finding it hard to kind of place their bets using the GIC sectors or these typical sectors that they used to operate in. They're also looking for ways to place short bets as well, and they can't figure out the right exposures that accurately express the ideas they want to place trades on. And so what we're seeing is this rotation, this gravitation back to the thematic ETF. And so what does that mean? That means more of a pure play ETF, usually a smaller basket, fewer underlying stocks, something from 10 to 20 securities that are very niche, targeted, pure play exposures that are offering the investors this kind of more surgical precision.
Interesting. Obviously, what we saw earlier in the year, the kind of AI scare that hammered a lot of software stocks. Are investors looking for opportunities to kind of hedge against something like that happening again in the future?
Yes, absolutely. So I think we look back at February's SaaS apocalypse, and this was investors kind of devaluing these software companies that had really been stalwarts in the market with fear that AI was going to replicate or take over some of those revenue lines. We're also seeing this migration into ETFs that hold kind of an AI immune basket. So these are companies that might not be as affected by AI because mostly they're real world assets. They're holding companies that hold things that you can touch and feel, things like machinery or paving, making asphalt, or electricity grids. But again, kind of this AI resilient trade that's really the opposite of the AI investment theme.
Because it must be hard. Like, we don't really know where this AI story is going, right? We're all on it together. We've never been through it before. It must be hard to know where to go and what areas you should be hedging yourself against moving forward.
Absolutely. And I think this is why we're actually seeing rotation into ETFs. Because, like you said, AI is changing so quickly. We don't know where the winners are going to be. We've already seen some stocks quadruple and then fall 90% in value. So it's very hard to pick the winners. A lot of these companies are unprofitable right now, so it's hard to kind of create valuation metrics. And so we're seeing investors saying, I like this theme in general. I don't know exactly which company is the best one, so I'm just going to own the basket of whether it's hyperscalers or quantum computing or memory chips. And you can do that easily within an ETF, is kind of own 10 companies instead of just stock picking one.
Is that why, like, I think we've touched on this before, but the ETF market this year in particular has been like booming, right? Like, there's just more people, there's growing interest in it. Is that part of the reason why, do you think?
Yeah, I think the ETF market is really just firing on all cylinders. And even in March, when it was quite a negative month and a risk-off month, usually in the past, ETF investors pulled capital out of ETFs. We actually saw them redeploying that capital elsewhere within the ETF structure. So even though the sentiment was risk-off, they were using ETFs to buy cash or to buy hedges or to buy gold. So I think it's really just firing on a lot of cylinders right now.
And then also we're seeing, obviously, markets like very volatile right now, a lot of geopolitical tensions affecting that as well. Is there anything else that investors can do to kind of hedge against those fears and maybe the oil prices going up, things like that?
Yeah, I mean, that's kind of the larger macro trade and what we're seeing investors look at. But also we're talking about kind of more tactical bets here and looking at other ways to enhance yield. And the ETF market has come to play there as well. We're seeing increased launches coming through on the covered call space, alternatives, or other strategies that are designed to provide alternate sources of income and potentially also capital preservation, but also a differentiator or a diversifier to just a typical fixed income sleeve within a portfolio.
You also want to talk today about the fastest growing ETF in Canada. So what is it and why is it growing so much?
Yes, so the ticker is CAGE. It's brought to you by CIBC and sub-advised by Avantis. And I think it's really impressive. So excluding bring your own assets or kind of internal rotation into ETFs, this is the quickest growing ETF in Canada. It's almost at $500 million in AUM. And it was listed, 8 weeks ago. So very impressive. And also, it was launched into a crowded space. So this is an asset allocation ETF that owns a portfolio of underlying ETFs. This obviously has been a banner place, but they are a late entrant. And to me, what this tells is that as long as you have a good story and you can communicate that story to your investors, you can gather assets. And it's no longer simply as having a good track record or a great product team behind it. It's about being able to communicate to investors why they need to own your product over others. And CIBC has been very successful here in kind of garnering this organic buzz and gathering assets.
Because how unusual is that to see an ETF gain that much ground so quickly?
Yes, it's really nothing shy of impressive. And I think that it hits on the fact that they've been able to communicate how this product is differentiated from the others in the market, how their factor-based systematic strategies can provide a better risk-adjusted return. And listen, it's resonating with the end investors. So kudos to them.
We just had a conversation before the last commercial break about Bitcoin.
Yes.
And you were listening to that. And we did talk a little bit about Bitcoin ETF flows.
Yeah.
But you say you've been noticing some trends as well. Can you tell us more?
Yes. So Bitcoin ETFs actually had their worst month on records from a fund flows perspective, meaning that since these ETFs were launched about 2 years ago, this was the most amount of capital we saw pulled from ETFs. Now, it's not catastrophic or scary. It's just a noticeable trend. And I think it's kind of twofold. One is the momentum trade. Listen, Bitcoin's been down and sideways. And so there's not a lot of juice or momentum in the trade right now. So people, I think, are exiting and maybe rotating towards the other punchier parts of the market right now, semis and AI and the like. And then also just a little bit of a rebasement trade finding its footing and going forward from here. But it is a nice diversifier in portfolios, and that's something we're talking to investors about a lot right now, is finding those other
avenues to kind of go down. Very interesting. Okay, we'll leave it there. Valerie Grimba, Director of Global ETF Strategy at RBC Capital Markets. Thanks for coming in. Appreciate your time.
Thank you so much.
Up next, Marvell shares are surging as NVIDIA's Jensen Huang sees the company hitting $1 trillion U.S. valuation. Stay tuned for more on that after the break. Stay with us. Canada-U.S. Trade Minister Dominic LeBlanc says the trade agreement with the U.S. and Mexico should be renewed for 16 years. He made that point in a letter to his counterparts. LeBlanc is in Washington today to meet with U.S. Representative Jamieson Greer. Canada's official negotiations over its trade agreement with the U.S. have yet to begin. Shares in Marvell Technology are surging today. This comes after NVIDIA's Jensen Huang predicted the semiconductor and networking company will be the next business to hit $1 trillion valuation. That's more than 5 times its current capitalization. NVIDIA took a $2 billion stake in Marvell 3 months ago. And shares of Dollar General are surging in today's trading as it beat analyst expectations on profit and sales in its first quarter report. The company says it was able to raise prices to offset severe winter weather and higher fuel costs. The American discount store chain also raised its profit and sales forecast for the coming year. And we're keeping an eye on North American markets this morning. A bit of a mixed bag. The TSX is up by 0.4% at the moment. Pretty flat, though, for the S&P 500 and the NASDAQ. We're continuing to watch that. We're also watching the price of oil today after a big surge yesterday. It is ticking down by 0.3% at the moment. This comes on optimism kind of fading around the prospects of a U.S.-Iran peace deal that was flagged by President Donald Trump. And we can see that the price of oil dropping on that news. Marvell's stock is soaring after NVIDIA CEO Jensen Huang said the chipmaker could hit $1 trillion U.S. valuation later this year. The rally comes as AI demand drives massive investment in data centers, fueling a broader surge across the semiconductor sector. Let's get more on this story from Amy Thompson from Bloomberg News in London, UK. Great to have you join us. Thanks so much. Appreciate your time.
Yeah, sure.
How realistic is it that Marvell could become $1 trillion company?
I mean, to get from where they are today, the price has already more than tripled this year. So they'd still have to increase another 300% or something along those lines. But we're seeing some really big gains in everything related to AI so far this year. So, who knows?
Who knows? But I mean, obviously, the fact that NVIDIA has an investment in Marvell, I'm assuming a piece of information investors should very much keep in mind and take what Jensen Huang is saying with a grain of salt. Do you think?
Yeah, I mean, these guys are partners. So the context for these comments was the Computex event in Taiwan this week. And this was Marvell's keynote, and Jensen Huang came on stage to sort of support their partners. So they definitely have an interest in Marvell doing well. They took a $2 billion stake in the company earlier this year. And maybe more importantly, they opened up their own systems to allow Marvell to integrate their technology in with the GPUs.
What makes Marvell, though, so important to the AI build-out? Because obviously it does have an important role to play.
Yeah, they have a couple of interesting roles in the AI industry. They, on the one hand, can build custom chips to help handle AI workloads for the cloud computing hyperscalers like Amazon. But they also provide technology that helps move power around the data center. So they're in this particularly interesting part of the tech called silicon photonics, which uses light instead of copper wires to move data faster and more more efficiently around. This type of technology has become really, really important as these data centers that handle AI workloads are having to manage more and more data and use more and more energy. They're really key in helping them keep up.
And as we were just looking at the chart of Marvell, the stock jumping again today, up almost 25% to start the day. Is the jump based on fundamentals, based on what the CEO of NVIDIA had to say, or just excitement around AI, do you think?
Yeah, I don't think Jensen Huang said much more about any new product rollouts or anything like that. So what we're seeing today is very much the excitement. There's a lot of exciting news out in the industry around AI today. Google said it's raising $80 billion in equity to spend on AI. There was some interesting earnings. ST Micro doubled its outlook for data centers. So there's a lot of things feeding into this today. But when it comes to Marvell, you are seeing a lot of real fundamental growth. Their sales growth over the last few periods has been really big, especially in the data center segment. They have forecast really high growth over the next few years, 40% or more in sales over the next 2 years. So there is some fundamental growth going on here too.
Okay, that's Bloomberg's Amy Thompson joining us from across the pond. Appreciate your time and your insight on this. Thanks so much.
Thank you.
Coming up next is Hot Picks. We'll zero in on 3 plays in industrials to watch out for when we come back. Stay with us. It's time now for Hot Picks, and today we are focusing on the industrial sector. Joining us now is Evelyn Chow, Managing Director at Neuberger Berman. It's great to have you join us.
It's a pleasure, Lindsay.
So before we get into your actual hot picks, I wanted to talk about this sector in general, because we've seen people, investors largely crowding into like mega cap tech names when it comes to the AI build out. What opportunities are you seeing in the industrial sector tied to the AI build out?
I think, Lindsay, that's a great observation because tech is actually not the only place where AI matters. And in fact, when you look at global industrial indices, some of the AI equipment and electrical equipment makers are the best performers in the index year to date. I think that is counterbalanced by also some cyclical uplift we're seeing in the sector. But there's a lot of opportunity to invest in some of the brick and mortar players within industrials that are building AI.
Right, because we've seen the AI investment story evolve this year into semiconductors. Do you see it evolving further into the kind of infrastructure story instead?
Absolutely. I mean, I think one of the names that I like best when I think about what are the major constraints facing data center buildouts today, it's actually how do you handle all this heat coming out of the data centers as chips get hotter and denser. So a name I really like is nVent Electric. The ticker is NVT. They've evolved from what has historically been a traditional industrial company about a decade ago into one of the leading ways to play liquid cooling, which is a technology that is involved now in about 15 to 30% of all AI deployments. And that number is meaningfully higher when you actually think about cluster deployments. I think one of the advantages of liquid cooling is that unlike air cooling, it can handle chips, especially in this new Vera Rubin generation, that are just getting hotter and hotter. And so liquid cooling actually is a very efficient way to transfer heat out of the data center. nVent is also doing that in a way where they're able to compound earnings 20% plus over a cycle, with organic growth driving that in the mid-teens or higher.
Another name you like is GE Vernova. So why has power become one of the biggest bottlenecks when it comes to AI growth?
Yeah, I think power has been kind of the debate du jour of what's happening in terms of the AI build out. So some estimates I've seen suggest that there's somewhere like a 15 plus gigawatt requirement for increased power generation demand annually, a lot of that being driven by data centers. And so there's this massive supply-demand gap within power. GE Vernova stands out because it actually has greater than 25% of gas turbine market share globally. And gas is going to be one of the leading ways that we're going to get more power for more data centers. What's really compelling about GEV is it has this multi-year backlog, $200 billion by 2027. That's going to give it a ton of visibility into its growth profile. It's getting that growth at a very high ASP, which is very mix accretive for the company. And it's also compounding that growth with an extremely strong services engine that itself is getting higher pricing as well. So, it's actually, the stock has taken a bit of a step back since its April earnings report. There have been some concerns around what could happen to capacity in the market as some of its key peers are planning to add capacity in 2029 plus. So I see this opportunity with this relative pullback as quite compelling for a name like GEV.
You've also highlighted contemporary Amperex technology, and this is about energy storage. So tell us how that kind of fits into the AI landscape and narrative going forward.
Sure. So, Lindsay, if NVEN is solving heat, GEV is solving power, then CATL is solving energy storage, which is one of the key technologies that's driving some of the deployments in AI data centers today. I think one of the things about CATL that's also very interesting is it shows that the data center opportunity isn't just constrained to North America, since this is a Shenzhen-listed company, historically an EV battery and battery materials maker that has carved out a leading position in the integrated full stack AI DC energy storage system ecosystem. Try to say that 10 times fast. One of the things I really like about CATL is not only has it demonstrated leadership in energy storage, but it's also demonstrating the ability to access the U.S. market through its tie-up with Ford. And it's also pioneering innovating technology such as sodium-ion batteries that will become a medium-term, very important solution for storage.
It's interesting because we've been hearing a lot of concerns about grid constraints across North America moving forward as well. Does power scarcity become one of the defining kind of investment themes of the next decade, do you think?
I think that's a really trenchant observation because, we're already starting to see that gap between cup and lip of how much power we're able to produce today, how much power we're able to get at multiple points in the day, and how much power data centers actually need. And so, you've seen across the ecosystem, transformer investment is up like 120% over the last 5 years, and that capacity is still not sufficient. We're seeing lots of interconnection increases. We're seeing, names like GE Vernova, which are having to step into kind of the breach here and try to figure out how do we get so much power into AI DCs because, they're dramatically reshaping the energy demand landscape in a way where it's actually growing after many years of very flattish demand growth.
So you've highlighted three names here that are within the same sphere, but they have different stories, and they're going to be helping with different things when it comes to the AI build out. Just quickly, is there any headwinds that any three of these names are going to be facing?
I think a very key industry headwind at this point is actually the notion of labor availability. It seems so counterintuitive that investing in this cutting edge AI technology should ultimately be constrained by something as basic as labor. But what we've been hearing is, when you talk to ENC companies that are the companies actually constructing the data centers, there could be a real labor availability gap, and this is quite skilled labor, especially as we look to end of decade. So, I think that's one of, frankly, the biggest constraints on the ability of some of these power and liquid cooling names to actually continue to accelerate, which is just the gating factor of what's happening when you simply can't build data centers fast enough.
Wow. Okay, we'll have to leave it there. Evelyn Chow, Managing Director at Neuberger Berman. Really appreciate your time. Thanks so much.
Thank you.
Up next, SpaceX is taking off, and we'll take a closer look at what's fueling the biggest IPO of all time. Stay with us. What began as a rocket startup is now a big bet on satellites, AI, and Mars. With a projected valuation near $2 trillion, SpaceX's IPO could actually reshape the markets. But as Bloomberg asks in this week's Short Doc, is Wall Street rushing in too fast?
SpaceX is taking off. And we're not just talking about rockets.
We've never seen anything like this.
SpaceX's initial public offering is expected to raise as much as $75 billion, more than double the record-setting $29.4 billion raised by Saudi Aramco in 2019.
This is the biggest IPO of all time.
We're looking at $2 trillion in valuation.
Elon long had said that he didn't really plan on taking SpaceX public, but that was before the merger with XAI, before he needed tens of billions of dollars to build out these ambitions.
But this massive valuation is also a test. Could all this hype make it seem worth more than it is?
If it's preordained, then it becomes hard to predict how much of the buyers are buying because of fundamentals or the valuation. So then that kind of distorts the market.
Investors are buying the dream.
Sure, we all know the dream, but what about the reality? Traditionally, an IPO, or initial public offering, was a primary way for companies to raise money. Going public was also a badge of honor. But today, companies have all kinds of access to capital to fund their early growth.
This is a huge narrative in the American stock market right now, where companies that used to go public at a very early stage now can wait really almost as long as they want because they have sources of funds that don't require public investors.
This trend has been fairly consistent, with the number of publicly listed companies in the U.S. falling since the 90s.
SpaceX is an extreme case, but it's definitely not a one-off. A lot of companies are choosing to stay private, choosing to scale privately, choosing to raise funds privately, and then go public. And when they go public, they're already a mega cap.
SpaceX's 277-page filing with the SEC takes about as long to read as A Journey to Mars. It depicts a conglomerate handling dollar amounts practically unheard of in any other IPO.
And that filing is giving us a little bit more of a peek here into the health of this company.
After 2023, the company made a profit of $791 million, only to lose $4.94 billion in 2025. But between 2024 and 2025, its total revenue continued to grow from $14 billion to $18.5 billion.
We're looking at an estimated revenue projection between 22 and 24 billion. But when you compare that to the total valuation of the company that SpaceX is looking at for this IPO, we're looking at $2 trillion in valuation. That is a very big discrepancy.
And you can see that discrepancy here. Looking at major tech stocks, investors value Tesla and Nvidia at roughly 15 times their annual revenue. They look like bargains compared to SpaceX and its price-to-sales ratio of 87 times.
SpaceX today is a very different company than the SpaceX that was founded more than 20 years ago. It is the largest satellite operator in the entire world with its Starlink constellation, with thousands and thousands of satellites operating in low Earth orbit that provide broadband internet to the ground below. So those are very real businesses that SpaceX has both commandeered and dominated.
Full power, and liftoff. Go Falcon, go Dragon.
On top of that, it operates rocket transportation services, either sending cargo and humans to space, even Mars travel someday. Those are still quite speculative and years away. All of these ambitious IPO-related programs all rely on Starship, and it's probably the most ambitious vehicle that's ever been conceived for spaceflight. It's meant to be fully reusable. That makes it extremely complicated, and its development process has been kind of rocky in order to get there.
And this is a rocket that last time exploded on the pad, so like you want to think it's going to go well.
So much of its value proposition is tied up in stuff that hasn't quite happened yet.
Even though rockets and satellites have been its bread and butter, there's another more pressing reason to go public now.
They're also slowly becoming an AI company and building out data centers to both train and operate AI in the future. The amount of capital that they need to execute on all of these really ambitious goals is just going to require a lot more than maybe they can receive from all of their various businesses in a short amount of time. This concept of using space as, this new real estate for putting AI data centers, That seemed to be the game changer that got Elon thinking, okay, now might be the time to actually go public.
An important aspect of SpaceX's IPO will be its inclusion in the NASDAQ 100 index.
We have these big indexes, like the S&P 500, it tracks the biggest 500 companies in the US, or the NASDAQ 100, which is the biggest tech companies. Many companies, or dare I say all, would like to be added to them because it means millions and millions of dollars of passive funds.
This passive money comes from everywhere: pension funds, institutional investors, retirement accounts. Together, trillions of dollars flow automatically into funds like Invesco QQQ, which tracks the NASDAQ 100.
If SpaceX is in one of those indexes, it means millions and millions of Americans will hold your company.
Once the company is included in the NASDAQ 100, any investors who are buying the QQQ will by definition be investing their hard-earned money into SpaceX regardless of the valuation.
Inclusion in the NASDAQ 100 or S&P 500 used to be a lengthy process, but now, since many companies going public are already giant, the rules are getting bent.
The old playbook was that you go public, you undergo a seasoning period, you prove your profitability, your liquidity, and then maybe you get added. The new playbook is the fast track entry. NASDAQ said, okay, we're going to fast track our rules. So instead of being public for 3 months, you can be part of the NASDAQ 100. And so SpaceX chose to list with NASDAQ.
Still, changing the rules to fast track a whale is not something you see every day in the markets.
There are a lot of risks when it comes to fast entry. There's price mismatch, liquidity, crowding, and there's also, of course, the over-concentration of mega-cap names, because increasingly, a lot of our holdings are just very few big companies. These few companies determine the future of your portfolio.
The market has become very concentrated. It's a very worrisome thing to a lot of people.
And SpaceX isn't the only big private company eyeing a blockbuster IPO while clinging to aspirational revenue goals.
If you look at companies like Anthropic and OpenAI and the rates at which they're growing and replicating themselves, those are going to be equally enormous IPOs probably in the not very distant future. You can see a case where maybe enormous companies become the rule as far as IPOs go.
Going forward, this is going to be the debate. How much dispersion should there be? Who are the winners going to be? And will the appetite remain for all of the other much, much bigger IPOs, it should be said?
Despite the warning signs, many are wary of underestimating Elon Musk.
He's really built an entire brand on turning science fiction into reality. And investors are willing to bet that even if he doesn't deliver on the timeline, some of these ambitions like orbital data centers or building a colony on Mars actually isn't out of the realm of possibility.
Yet the pressures of being a public company have a cost.
When you shift to a public company, your focus becomes more on short-term profits and how you're maximizing those profits for your shareholders. When it comes to space, there's a very long lead time of development. They also need to be able to fail. We've seen quite a few explosions. That doesn't always sit well with investors and shareholders, so it remains to be seen if SpaceX can actually pull all this off.
What looks like plausible ambition may end up being completely baseless hope.
For now, though, the market seems to have SpaceX FOMO on an IPO with potential massive payouts. Someday.
You buy at $1 trillion, you could potentially sell at $2 trillion. This keeps happening, and that's pretty much the story of why SpaceX makes sense to a lot of people.
Join us Wednesday at 3 p.m. Eastern for Know Your Options with Chris Tom of Moat Financial. You can send in your options trading questions now to knowyouroptions@bnnbloomberg.ca. That wraps up this edition of the Open Morning Markets is up next with Roger Peterson.